This is Rob Barnett, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and recent developments in energy markets. Today, we've got a very special guest. Emma Coker from BloombergNEF has kindly joined us. She's the head of carbon analysis here in Europe. If you haven't met Emma, I suggest you check out her research on the terminal. In addition to Emma, you've got the normal crew here. You've got Patricio Alvarez here in London, Salih Yilmaz in Dubai these days, and Fernando Valle joining from the New York area. So Emma, since you're our special guest, we are going to start with you and the carbon market in Europe. Last year, in 2021, carbon was one of the best performing global commodities. It's taken a little bit of a breather this year by comparison. So give us a sense, how do you read what's unfolded in the market? And I know you've got a pretty bullish outlook longer term, but kind of what does 2023 look like from your perspective?
Of course. Thanks, Rob, and thank you for having me. As Rob said, yeah, my name is Emma Coker, and I sit at BNEF here based in London. Carbon has been on a ride. What a time to be in the carbon markets the last couple of years. I think since 2019, the MSR's really kicked things off, and then, last year with the rally in other commodity prices, carbon's been at the whim of that. So we've seen carbon be stuck in between a bit of a tug of war, is a phrase we've used a lot in the last few months. Energy security versus energy transition has really been playing with people's picks for carbon prices. So our base case forecast for 2023 is 79 euros per tonne. Our forecast for this year is 81 euros per tonne, so pretty much a sideways move. And this is due to a number of competing factors. So the big one we saw was actually gas to coal switching, which we haven't seen in years. Fuel switching was obviously coal to gas for a lot of years, and pretty much attributed the success of the EU ETS in reducing emissions. That obviously backtracked at the end of last year coming into this year, and we're actually predicting emissions to be up even relative to 2019 levels. This, of course, is being offset by industrial demand destruction and recession fears. So we do factor in an economy-wide shock to the EU ETS sectors, around 6 to 7% coming in for next year as our base case lowering emissions. And then, of course, we've got policymakers in the mix who got a bit nervous about the incredibly high spike in carbon prices, arguing it might not be fundamentals, it may well be speculators. We had the proposal on the table originally to ban speculators from the market. That obviously got pulled back last week and is off the table, but they're still looking to intervene, both to fund the transition away from Russian gas and in the long term to reduce the cap, which is part of our bullish forecast.
Okay, so one thing to just alert everyone to, I think we've got a lot of oil and gas folks on this call. They probably don't speak all the lingo of the carbon market. So MSR, one of the first things you mentioned is market stability reserve. It's kind of a way to make the cap go down faster, is sort of the way to summarize it. But a follow-up question for you generally would be, we've got the COP27 climate conference going on right now. I see that as pretty distinct from the ETS, but they are related. So when you think about COP27 and what Europe has done on carbon, how do you see it fitting in with the rest of the world's carbon ambitions? Are we headed eventually towards more global carbon pricing?
Yeah, it's a great question. I think there were two things we were looking out for at COP27. So one big thing is Article 6. Article 6 of the Paris Agreement is the agreement to allow countries and companies to trade offsets with each other to achieve climate goals. So there's two main articles, 6.2, which is country to country level trading, not quite as exciting for BI clients, I can imagine. But 6.4 is the exciting one. It's the one that's going to take the longest. It effectively establishes a global offsets carbon market. So anyone could come in, supply credits to those markets or buy credits from those markets. it effectively would replace the voluntary carbon market as it is today if it's effective, but it would be the regulated version of the voluntary carbon market. So that's what we've been keeping an eye on. Unfortunately, COP27 hasn't seen much movement in that regard. We saw a few draft texts come out, but the consensus is there is not widespread agreement amongst the parties. So we're at a bit of a deal break with that at the moment. We're hoping in the next few days we'll see some movement on that. The one other thing was the announcement yesterday about increasing EU's ambition instead of the Fit for 55 target, the 55% reduction in emissions by 2030. They're now going for Fit for 57. Doesn't have quite as much of a ring to it, and this accent not great either. But this is either to be achieved by sectors in the EU ETS or the effort sharing regulation. So the effort sharing regulation is for sectors that aren't covered by the EU ETS. So that's buildings and transport. They're expected to do less overall under Fit for 55, the original package. They were expected to reduce their emissions by 40%. EU ETS sectors were expected to reduce their emissions by 61%. So if we're increasing it to 57, those relative shares are going to increase as well. But we're still waiting for details on how that's going to play out for both the ETS and member states.
Okay, very interesting. So I want to take the conversation over to Fernando here for a second. Fernando, you look after Exxon and Chevron, who for the most, I mean, Chevron's got a little bit of exposure to the California carbon market. Exxon Mobil has a little bit of exposure to the ETS through some of their refining operations in Europe. But how do you think about the carbon market, and do you see any kind of interplay with some of the integrateds in the U.S. or
Yeah,
Americas generally?
absolutely. I think, even if you take it extended further to the refiners, there's huge interconnection between those. Surprisingly enough, both of the Exxon, especially Exxon, to be fair, and Chevron have been big defenders of carbon pricing and an explicit carbon pricing. They're also exposed to carbon pricing in Alberta through their subsidiary Imperial Oil and the oil sands. So they their view is that if you have a carbon pricing that is effective on all parties, they'll actually be net beneficiaries because one, they have the scale to offset that. Two, it actually, because they are in high emitting positions, they can use that carbon tax to develop carbon capture, which is really their main focus on reducing emissions. We've talked about this a lot in our research. There's this fundamental difference between the European majors and the US majors on how they see energy transition. And Exxon and Chevron are much more of the thought that we need to use existing infrastructure and decarbonize that infrastructure rather than change the energy matrix drastically, which is why you see them investing in renewable fuels as opposed to renewable power.
Okay, Salih, let's swing over to you and get some perspective from both the European and Middle Eastern oil patch. Some of the refining names that you look after have some pretty hefty carbon price exposure to some extent, at least on the marginal barrel. So how are they thinking about the ETS and just the carbon question more generally?
So I don't think they care about it as much right now as they used to maybe a couple of years ago. I mean, last time we did an analysis on this was back in 2000 early last year, I think, and those were the times when the European refiners had very, let's say not very favorable refining margin environment. And our analysis showed that the carbon prices at 50 euros per ton would actually trim the refining margin by 40 cents or slightly more. And back then, this was actually a significant amount. And in some instances, in some quarters, this could actually flip some of the relatively old refineries from being profitable to not being profitable. Right now, they're enjoying pretty much all of the companies that I cover had double-digit refining margins, more than $20 a barrel refining margins in the second quarter. These have eased, but still more than $10 a barrel in most cases. So right now, it's not something that they perhaps care about as much, but looking long term, and given, I mean, carbon prices have eased a little bit, but still above the 50 euros per ton that we used in our analysis more than a year ago. When it comes to the Middle East, I mean, Aramco has some refining exposure in Europe, and they have made more acquisition this year into a stake in Polish Lotos. So they have some exposure through that. But like I said, I don't think it's on the top of their mind right now, just given how profitable these refineries have been.
Emma, I want to get just your perspective, because we've really only been talking about the refining stack emissions so far, and I know there's always ongoing conversations around the ETS about expanding it maybe to include other sectors. In California, the downstream fuels are actually part of their cap. Is that ever going to happen in Europe? And do you see the carbon cap and trade program essentially expanding shipping or other areas?
Yeah, exactly. So that's been the focus of a number of these reforms. So we expect maritime to come within the EU ETS from 2024, just given the legislative process takes a while. Originally it was supposed to come in 2023, but that's still being debated. I think there's some interesting scope changes, buildings and transport being one. This initially was going to happen towards the end of the decade, and then policymakers got pretty nervous after household costs this year have skyrocketed. Buildings especially is now much more questionable about whether it will be included even this decade, even in terms of households alone, or whether it will just be commercial heating. I think the interesting thing for industrials who are within the scope already is the potential phase out of their free allocation if a carbon border adjustment mechanism is introduced from 2026. Again, still being debated on timelines, but European lawmakers seem pretty on board with the introduction of it. Just, the debates are around when, and this would mean a phase out more broadly of around 10% of that free allocation each year. If we're exposing industrials to a carbon price that we're expecting to be around 147 euros per tonne by 2030, it's a pretty significant entry into the scheme for a number of these margins in particular.
Very interesting. Okay, Patricio, I want to come over to you and try to get some of your perspective on the impact of the carbon market on the utilities. Do you see this shaping investment decisions? How's it been affecting their profitability in the near term here? And there's all this question about cost pass through with the elevated gas prices. Is there an issue with the carbon price pass through right now?
So yeah, that's a great question. I think trying to unpack that to begin with, I think European utilities have been at the forefront of renewable capacity expansion and investing in renewables, wind and solar. So in that sense, the near-term sort of spike or volatility in carbon pricing is not set to change the strategic direction of most European utilities, especially the diversified majors like Iberdrola and Enel. Which by and large have already planned to phase out their coal-fired plants even faster than most of the national targets that they abide by. So we've already seen they have a clear path to decommissioning most of their coal plants and lignite plants as well. In terms of the cost pass-through, there are a group of select utilities that are not. A few utilities that were not hedged, I'd say, in terms of carbon permits. And one example would be, for example, ČEZ. ČEZ is the Czech Republic's largest power generator, mostly having nuclear and coal-fired plants. They have been exposed to higher carbon costs, but the power price upside that they are receiving on these very low cost technology. So nuclear is very low marginal cost technology, and a big chunk of it is unhedged. So they have seen that power price momentum offset any concerns in terms of carbon pricing in the near term. And just bringing it back, I think most European utilities have already foreseen the or have already sort of reflected this the phase out of coal in their 5 and 10-year plans already. And a good example is I think one to highlight would be RWE. It's a company that is amongst the largest lignite-fired operators, if not the largest in Europe. But that company is fully hedged to 2030. It's a company that has already bought all the carbon permits it needs to 2030. It's phasing out lignite earlier than what the national target is, which is 2038. So they are accelerating their phase out. So that I think that exemplifies really well how utilities are managing this part.
Okay, thank you very much, Patricio. Let's consider a little bit about the idea of energy transition versus energy security. And Emma, we've been having this really interesting ongoing conversation about security of supply versus the idea of, you know, hitting net zero out in 2050. And I think some folks would argue that the idea of carbon, at least here in the short run, or just ESG pressure in general, has distracted companies from making appropriate supply investments on the fossil fuel side of the equation. I know you don't really think about that when you're trying to balance the carbon market, but give me a sense of kind of how, as a carbon market analyst, do you think the carbon has distracted other market participants from investing in other components of the energy space?
So I think it was interesting, the estimates of how much carbon costs were responsible for some of the spikes we saw earlier in the year. I think there was pretty broad agreement that carbon actually was less than 10%. I think EU Commissioner said 6% of the increase that we saw in prices, and that largely it was based on fuel prices. In saying that, carbon's not off the hook. I think what we saw was lawmakers get nervous around the trajectory of carbon. And so we've actually got two sets of competing reforms trying to do different things. So in the near term, we have the Repower EU package, which is looking to raise 20 billion euros from carbon revenues. So we saw originally the Commission say it should be from the Market Stability Reserve Fund, so extra allowances. Since then, that's kind of gone off the table, and actually the Council and Parliament have just been debating how many front-loaded allowances would be used to raise that. Any front-loading depresses the prices in the near term, hence why our base case is 79 versus a 91 euros per tonne if we actually didn't have that funding target. That near-term depression sees less investment in renewables or abatement opportunities, and that's actually what causes the price spike later in the decade for us. So it's a short-term gain for some long-term pain is what we would categorize it as. It goes against the Fit for 55, now Fit for 57 regulation, which is effectively looking at tightening the cap and putting more pressure on ETS sectors to align with net zero. So this is why the Fit for 57 now legislation has been so hard to push through this year, because policymakers are looking very much more on the near term.
Fernando, I want to come to you on the idea of energy security as well. In the past, you've talked about potential new resource in Canada, for example, and you mentioned the Alberta carbon program. How are folks in the oil patch thinking about the near-term need for new oil supply and some of these longer-term strategic questions on carbon? Does it balance for them? Is it a distraction in your view to think about these ideas in the same breath?
Absolutely. I think when you consider, for example, the European natural gas markets right now, if you speak to LNG suppliers in the US, they'll say that Europe wants to sign LNG contracts for new capacity in the US, but they only want to sign 5-year contracts. But these are massive projects that typically have a 15 year payback period. So a 5-year contract doesn't really warrant you building the actual project, and that's Europe's belief that they will, the natural gas supply issues will be solved within 5 years, and they won't need that supply. Which it's its own argument, but I'll leave that for right now. When you take it on the oil side, similar long paybacks. When you look at the oil sands, the biggest issue with oil sands growth right now is how do you get the oil sands out of Alberta? And the policies have not enabled new pipelines and new capacity to move that crude out of Alberta and into the Gulf Coast, the west coast of Canada, or even the east coast of Canada. So they are limited in how much they can grow, and their returns would drop significantly if they just built, because we've seen that spreads for their crude can drop massively once the inventory runs out in Alberta, because you can't move that anymore. So the carbon tax itself, Alberta is phasing out their carbon tax because it's going to move into a federal tax in Canada of 130 Canadian dollars per ton by 2030. It's fairly aggressive, but as Salih was saying, it's actually small relative to the margins on the upstream side. You make $35-$40 a barrel, so it would be 50-60 cents. It's not a game changer, but the lack of infrastructure is really and the capacity to market your product is what deters further investment. And then we have these short-term supply gaps because we haven't invested in the infrastructure and the new supply that lead to price spikes, not just in the commodity itself, but in power and in other areas of the concepts. So as Em was saying, direct carbon prices are only a factor of it, but the lack of redundancy and the lack of supply, the lack of investment in supply to back up renewable generation really was the driver for the price spikes. And you saw it in the UK, for example, where electricity prices spiked in January prior to the invasion because there was so little wind generation at that time.
Fernando, I want to ask a quick follow-up question on the long-term contract issue. What's your perspective on why the LNG producers want the long-term contracts, but I don't think there's an analog on the oil side, or maybe there is. Why is it so necessary on LNG? Is it particularly more capital intensive than oil?
Yeah, it's also a margin business. You're not actually producing anything. You're a refinery, and you can't. There isn't as developed of a spot market or even a trading market, so that you can't really hedge out your output for several years out, as you could, for example, with refining. Right? There's a reason no one's investing in refining, is because you can't, in the US at least, because you can't see the line of sight to margins 15-20 years from now. And that's the same. An LNG is much closer to a refiner than to an upstream producer. They're just taking natural gas, cooling it, and then shipping it off. So it's a really thin margin business at the end of the day. So you're really it works on volume, and if you can't hedge out that volume at least 5-6 years out, you're not going to do it without a long-term contract.
Salih, I want to come over to you on the idea of energy transition as well. IEA has lowered their 2023 outlook for oil demand, I believe, just recently here. How does that play into the current market dynamics, and is ESG or the energy transition one of the factors that's driving anything in the near term, or is it more about the economic story?
I think it's more the economic story. So they actually increased their demand growth expectation for this year, but probably more importantly for next year, they reduced it, and that number is now, the growth number is now 1.6 million barrels per day. And the main risks, the major risks that they are talking about is China and the lockdowns in China and the energy crisis in Europe. So I think in the very near term, this is what they're focused on. But in their longer reports, with some of their longer projections, especially in the more optimistic scenarios, they obviously have ESG and the climate policies really trimming oil demand, and they see oil demand peaking earlier, like middle of this decade, and going down from there.
Patricio, just coming over to you. I think your companies are, as you've already noted, are big investors in renewable energy. But how are they managing the energy transition? We've talked already about the gas side of the equation, but as I think Emma sort of implied, coal is utilization's up here in Europe, and it's also occurred in a market where coal prices are actually pretty expensive as well. Not quite as high as natural gas, perhaps, but give us a sense on the coal dynamic for your companies.
So I think if anything, we see, I think the utility space will not make any significant capital allocation towards renewing or modernizing their coal-fired fleets. I think the current sort of dynamic of higher power prices in the near term will be capitalized by the companies who have a larger share of flexible generation. So that's dispatchable power. So companies that have both a renewable asset base and also some CCGT and some coal-fired units will benefit during this next 1 or 2 years, where it looks like we're going to see higher than average commodity prices, and whilst retaining, the strategic direction towards a greener power mix by the end of the decade, by and large. And we've also seen a little bit of a transition as well in terms of capital allocation in the near term towards more regulated asset returns. So some of the companies are sort of slowing their, I'd say, slowing their investments in renewables, at least in Europe, and favoring investments in networks, so in power networks, both in Europe and abroad. And I think that sort of reflects what the regulatory environment in Europe is at the moment as well, because the energy crisis has brought about major, a lot of intervention and proposals to reform the power markets, to reform the gas markets, to cap power prices, for windfall taxes, all of which are I think that the only meaningful risk for European utilities earnings in the near term, at least. If anything, if commodity prices start to smooth out from next year, that could be a good thing for European utilities, as they've already locked in higher power prices, and they'll see their energy sourcing cost sort of smooth out and ease when gas prices ease. So it seems like the outlook for them is improving both domestically and abroad, but regulatory risk continues to be a major headwind.
Okay, we got time for just one more big picture question, but before we come to that, Emma, there is a question from one of the clients in the chat. I think it should be a quick one for you. Is Fit for 57 confirmed?
Yeah, it's not. It's just been announced. So yeah, it's yet to be actually formally adopted.
Okay, so I want to end and circle back around on the commodity outlook across all the fuels that the teams cover here. So Emma, you may not be aware, but BI puts out a prediction note every year that looks across a number of things. And last year, one of the predictions I made for this year was that the European carbon price would average at a higher price than Brent crude oil. Now, Fernando, he tried to convince me that that was not a very good prediction. I didn't listen to him, and I'm going to have to write my mea culpa really soon here. But you talked about your base outlook for carbon. Is there an upside case if the stars align? What does it really take to move into a higher carbon world in 2023 in your view?
Yeah, so our 79 has as I said, a baked-in assumption that 6.3% economy-wide shock for the ETS sectors hits. It also assumes that we adopt the Council of the European Union's Repower EU package, so that 50 million allowances will be brought into the market in the years between 2023 and 2026. So we have a additional scenario that looks at no repower. That's our 91 euros per tonne. You could go further and say no emissions reduction due to economy-wide shock. That could push even further. Or we could see a situation where gas prices continue to stay incredibly high and the emissions from the power sector keep going, in which case all of those are pretty bullish factors that will continue to drive it up. We're waiting to hit that 100 euros per tonne. We got incredibly close a couple of times this year. We wouldn't be surprised if volatility takes us over there, but on average we think it'll still be, more around 79.
Okay, very good. We'll certainly hope that a recession doesn't unfold, which is part of your more pessimistic view. Okay, Patricio, let's come to you. Give us the gas view for 2023. How do things look?
I think they look uncertain. I think that's a short way to put it. It seems like if we take it by parts, I think the winter outlook looks much better than it did a few months ago, because we've seen an influx of LNG and higher flows from Norway broadly offset most of the Russian gas curtailments via pipe this year. And we see a fairly resilient outlook for the winter with demand easing significantly. We've seen October gas demand drop by more than 20% year over year, and there's signals that November will be somewhere around the same region. So if anything, we've gained around a month and a half of within the heating season of very low demand. We have full, almost near full storage levels. So it looks like we might be able to get through the winter unscathed. And if we come out of the winter with storage levels around 40%, which is the historical norm, I think gas prices in 2023 will very much be dictated by Asian demand for LNG, and that remains, I think, the main uncertainty. Will Asia rebound more than what this global supply LNG outlook is able to provide on top of what we had in 2022? I think that's the main question. So prices will likely remain elevated versus their previous 5-year average. But at this stage, it's still a bit uncertain to what degree. We do have different scenarios, but what we do expect them to stay relatively elevated.
Okay, very cool. Fernando, let's come over to you. First of all, I owe you a beer next time we get together. I feel like I've lost the bet, but tell us, where's oil going to head next year?
Well, I guess it's the same generic outlook of it depends on recession and the fears around it. As Emma alluded to, part of the way that we've been able to both reduce power prices and fill natural gas inventories was demand destruction, which is never good for the economic activity and impact on the broader economy. Our view is there's still a potential downside from both higher interest rates, China's struggle with COVID zero, and just economic fallout from rationalization of energy in Europe. But towards the second half of the year, we see crude going higher. And the biggest driver behind that is the lack of investment in the supply chain, not just since COVID, but really since the 2015 price crash. We've seen CapEx drop off significantly in that period, and especially after 2020, and we're still just recovering. And when you look at the production outlook, a lot is expected from U.S. shale, from OPEC Plus, and from Brazil, and we think all three can disappoint. U.S. shale is already disappointing. Production's been relatively flat, as opposed to most folks expecting 500 to 600,000 barrels a day of production growth. We think most of the high quality inventory is gone, so those kinds of growth rates are beyond us now. And you're also dealing with cost inflation. OPEC Plus, and I'll let Salih discuss this more, but there's a question whether they cut production quotas because of prices or because they really can't sustain those levels of production over a long period of time. and there are questions as to their ability to continue to grow supply. The UAE is probably the more tenable growth, but Saudi has questions on their sustainability, and then finally Brazil, where there is a lot of growth expected in the beginning of 2023. They already have the platforms, the units in place in Brazil and going into location. But beyond that, the president-elect of Brazil, Lula, wants to go build refineries as opposed to grow production. And we saw during his first 2 terms and his successor's 2 terms that is a not very positive strategy for Petrobras and Petrobras's long-term growth. So if they switch tacks to growing again in refining, we expect upstream will take a backseat. And so we see a supply deficit starting to materialize in the second half of 2023 and then into 2024.
Okay, Salih, we're going to give you the last word here. What do you think about Fernando's segue there on the idea of OPEC supply growth? I think you're pretty aligned on sort of the price trajectory. And the one last piece of the question that might be interesting to hear you frame, if price is high and you get lots of cash generation from the oil companies, what are they going to spend the cash on?
Yeah, sure. So I totally agree with Fernando, but pretty much everything he said, especially on China. I mean, this has been a huge overhang on the demand side for oil, and we think that it's going to be difficult for China to significantly reopen in the first half of the year. But through summer, I think there is a good chance that they can reopen notably, and this will be a huge tailwind on the demand side. And of course, there are the recession fears, but I mean, arguably, these may already be priced in. And then we expect huge uptick from jet fuel demand as well, especially in the second half of the year, as Fernando said. And on the supply side, again, totally agree. I think there are a lot of question marks around how much more OPEC Plus could be producing more of anyway. So, I mean, right now they've changed their strategy to go back to, cutting outputs. But then, I mean, arguably, once demand picture is better, they will revert back to increasing supply. But it's really not clear outside of Saudi Arabia and the UAE. It's not very clear how much the rest of the group can increase output. And even Saudi Arabia, I mean, we haven't really seen them produce more than 11 million barrels per day for a prolonged period of time. So there are some question marks there as well. So certainly the supply picture doesn't look great either. So we certainly see a tight oil market continuing, especially in the second half of the year. And I mean, this obviously means elevated prices for longer, so higher for longer prices for oil companies, for oil majors like Aramco. So we could see just another year of quarter after quarter, very healthy cash generation for them. And we expect to see similar things in terms of how they spend the money, higher spending. I mean, Aramco has been a little bit of an outlier in terms of being quicker to increase their spending, but we could see the other global majors doing perhaps a bigger increase in their capex next year. Higher buybacks. I mean, this is especially for majors in the US and for Europe. We saw dividend hikes, and we saw in some cases special dividends. So all of these are on the table still, as these companies just continue to make a lot more money than they were just a couple of years ago. So that's it for me.
Okay, we'll leave it there.
Rob, if I can plug really quickly, our outlook for integrated oil and gas was published this morning with contributions from Salih and Will, who can join us today. So
yes, yeah, absolutely. There's a BI Intog is where you can find a lot of the research. There's a BI OPEC dashboard. For Emma's content, you can type BNEF Go on your Bloomberg terminal. They also have a web platform. We're all on IB. We're easy to find. So shoot us an instant message if you want to find any of this. We're happy to help you get you pointed in the right direction. Or if you have follow-up questions, just reach out to any one of us, and we're happy to engage on all of these kinds of topics we discussed here today. So thanks so much, Emma, for joining us today. Very cool to get the broad perspective on carbon that you have, and look forward to having you on again at some point in the future. Have a great one, everyone.
Thank you very much.